Imagine this. You have always thought of silver as a quiet and reliable metal, something used for coins, jewelry, or perhaps as a safe way to protect your money against inflation. But what if I told you that right now, as we speak, silver is breaking all previous records? It has reached $67.40 per ounce. And this is not just a random jump in price. It is the beginning of something much bigger, a powerful force that has been building quietly in the global markets for years. Why is this happening in 2025, of all years? What exactly is pushing the price so high that investors are rushing in and entire industries are feeling the pressure? Stay with me, because the real reasons lie hidden in a combination of severe supply shortages, massive demand from factories, and an old market pattern that is repeating itself after many decades. By the end of this video, you will understand why this surge is not just temporary news. It is a clear signal of much larger changes coming in the future. To truly understand what is happening today, we first need to go back and look at the long history of silver in our world. Silver is not new to human civilization. It has been valuable for thousands of years. Ancient civilizations, like the Egyptians and the Greeks, prized it for its beauty, purity, and excellent ability to conduct electricity. They used it in trade, jewelry, and early forms of technology. Fast forward to the 19th century. Silver became deeply connected to modern money systems. In the United States, the Coinage Act of 1873 effectively removed silver as official money. The country moved to a gold standard instead. This decision created huge political debates that lasted for generations. Many people called it the crime of 1873. This event marked the beginning of silver's changing role. It slowly shifted from being mainly a monetary metal to something more tied to industry and manufacturing. Here is what makes silver so special and different. It has a dual nature. On one side, it is an investment asset that people buy to store value. On the other side, it is an essential industrial material. Unlike gold, which is mostly bought and stored in vaults, more than 50% of all silver produced each year goes directly into factories. Think about electronics, solar panels, medical equipment, and countless devices we use every day. This double role creates unique pressures on the price. Investor feelings can move the market, but real demand from industries pulls even harder. When that industrial demand grows faster than available supply, serious problems start to appear in the entire market system. Now, let me introduce some of the key players who have shaped this market over the years. Large banks and trading companies have long controlled commodity markets through something called futures contracts. These contracts allow traders to bet on future prices without actually owning the physical metal. One of the most famous examples comes from the late 1970s. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, were extremely wealthy from oil money. They believed silver was severely undervalued during a time of high inflation and global tensions. So they started buying huge amounts of silver, both physical metal and futures contracts. Their goal was to control a large portion of the available supply and push the price higher. At first, their plan worked amazingly well. Silver prices rose from about $6 per ounce in 1979 to over $50 by early 1980. The brothers controlled an estimated one-third of all privately owned silver in the world. This created panic among traders who had bet the price would fall. Those traders are called short sellers. The reason this strategy was so risky was leverage. Futures markets let you control large positions with only a small amount of money up front. But leverage works both ways. When prices kept rising, regulators and exchanges stepped in. They increased margin requirements and limited how much anyone could hold. The Hunt brothers could not meet the sudden demands for more cash. This triggered a chain reaction. On March 27, 1980, a day now known as Silver Thursday, the market completely collapsed. Prices crashed from $21 to $10.80 in just one day. Billions of dollars disappeared. The brothers faced massive lawsuits, huge fines, and eventually bankruptcy. This dramatic event showed the world how concentrated positions could destabilize entire financial systems. This was not an isolated case. Many years later, major banks faced similar accusations. In 2020, one of the largest banks, JP Chase, agreed to pay a record $920 million fine to United States authorities. The reason? Manipulating precious metals markets, including silver, through illegal tactics known as spoofing. This meant placing fake orders to trick other traders. The bank admitted these practices went on for 8 years and involved hundreds of employees. These events highlighted a continuing problem. Large banks often hold massive short positions on the main United States futures exchange, called COMEX. Sometimes, these positions keep prices lower than what real supply and demand would suggest. Why am I telling you all this history? Because market patterns tend to repeat when the same conditions appear again. Starting in the early 2020s, silver's story began to change once more. The global pandemic in 2020 disrupted mining operations in major producing countries like Peru and Mexico. Supply chains broke down, creating the first serious shortages. But that was only the beginning. As the world economy recovered, a completely new wave of demand appeared. This time, it came from green energy technologies. Solar panels, which are critical for renewable energy, need silver paste to conduct electricity efficiently. In 2020, the solar industry used about 100 million ounces of silver per year. By 2024, that number had more than doubled to over 200 million ounces. This explosion happened because governments around the world pushed massive solar installation programs to fight climate change. Electric vehicles added even more pressure. Modern electric cars use up to 50% more silver than traditional vehicles. Silver is needed in batteries, wiring, and many electronic components. Governments introduced huge subsidies and mandates. The United States passed the Inflation Reduction Act. Europe launched the Green Deal. Global electric vehicle sales reached 14 million units in 2024. Every single one of those vehicles pulled more silver out of the market. Then came the unexpected surge from artificial intelligence. AI data centers, the massive facilities that power chatbots, cloud storage, and machine learning, require silver for high-efficiency electrical connections. One large data center can consume thousands of ounces of silver. With companies like NVIDIA and Google announcing new facilities almost every week, this sector's demand grew extremely fast. All these forces came together and created what experts call a structural deficit. This means demand was consistently larger than new supply. In 2023, the Silver Institute, the leading research organization for the silver market, reported a global shortfall of 142 million ounces. That is how much more silver the world used than it produced. Mines could not increase production quickly enough. Most silver is actually a byproduct of mining other metals like copper or lead. This makes supply very inflexible. Recycling helped a little, covering about 25% of needs, but it was not nearly enough. By the end of 2024, global inventories had fallen significantly. Prices started rising steadily from $23 per ounce in January to $32 by December. Analysts warned that 2025 would bring even larger deficits, somewhere between 95 and 149 million ounces. Industrial usage was expected to hit new all-time records. At the same time, short positions on COMEX continued to grow. Many traders and banks bet that prices would stay low or fall, expecting an economic slowdown. But as physical demand kept increasing, those short positions became dangerous. More and more contracts were taken to delivery. This forced short sellers to either buy back their positions at higher prices or deliver actual metal they did not have. This is the classic setup for what we call a short squeeze. Rising demand meets limited supply. Short sellers are forced to buy. Their buying pushes prices even higher. This creates a powerful upward spiral. And when 2025 began, the price rise started speeding up. By March, silver broke $40 per ounce, helped by massive solar exports from China and new electric vehicle incentives in the United States. During the summer, the artificial intelligence boom added more fuel. New data center announcements came almost every week. Silver's superior conductivity made it impossible to replace in high-performance applications. Attempts to use cheaper alternatives like aluminum failed because they simply did not perform as well. Mining regions in South America faced labor strikes and stricter environmental rules. All of this made supply even tighter. By October 2025, the situation felt like a pressure cooker ready to explode. Physical silver inventories in major storage vaults, especially in London, had been falling for years. Reports from the London Bullion Market Association showed sharp declines. Metal was becoming stuck in forms or locations that could not meet immediate needs. Traders faced extremely high lease rates, the cost to borrow physical silver for short periods. Short sellers were desperately searching for metal to deliver. Large buyers in Asia, including reports of major purchases from India and China, created instant tightness. Prices began to differ between different trading hubs. This led to expensive shipments across oceans, but even that could not close the gap fast enough. Then came the real breaking point in late November and early December. Prices that had been climbing steadily all year, starting from about $29 in January and reaching the mid-50s by fall, suddenly shot upward dramatically. On December 17th, silver broke through to a new all-time high above $66 per ounce. By December 20th, the latest close was at $67.40 per ounce. As of today, December 21st, the price is holding around $67.40 per ounce. This sudden vertical move was not caused by one single event. It was the result of everything building up together. Short sellers on COMEX and other exchanges faced huge losses. They were forced to buy back their positions. Every buy added more upward pressure. Exchange-traded funds that hold physical silver saw massive inflows as new investors rushed in. Both retail buyers and large institutions recognized the shift. Physical delivery demands reached levels rarely seen before. The effects were felt immediately across many areas. Short sellers, including some hedge funds and banks with old positions, suffered enormous losses. Reports appeared of forced liquidations. Positions closed automatically because losses became too large. Industries that depend on silver, such as solar panel manufacturers, electronics companies, and electric vehicle producers, suddenly faced much higher costs. This hurt their profit margins, even as they tried to increase production to meet green energy targets. Some companies worked harder to use less silver per product, but newer high-efficiency solar cells actually required more silver paste, not less. Supply chains became strained. Premiums, the extra cost above spot price for physical bars and coins, shot up in retail markets. Dealers reported long delays and higher prices. On the positive side, mining company stocks rose sharply, rewarding investors who owned shares in producers. Attempts to fix the imbalance did not work well. Regulators watched closely but found no single person or group illegally controlling the market, unlike some past cases. Exchanges raised margin requirements to reduce extreme speculation. But the basic problem, the structural deficit, remained unchanged. New mining projects take many years to develop. Primary silver mines are rare. Most silver comes as a byproduct, and those projects face delays from permits, high costs, and regulations. Recycling increased slightly and passed 200 million ounces for the first time, but it still only covered a small part of the shortage. Some governments encouraged more domestic production, but geopolitical issues and environmental rules slowed progress. Central banks and large sovereign buyers continued quiet accumulation, adding demand without adding supply. This brings us to the most important part, the shocking similarities with today's situation. The Hunt brothers' attempt in 1980 had the exact same ingredients: strong physical demand, large leveraged short positions, and a trigger that caused explosive price moves. The J.P. Morgan fine in 2020 showed that paper market games can sometimes hide true physical realities. Even the price peak in 2011, driven by investment during easy money policies, followed a similar pattern. But 2025 is different because the main driver is industrial consumption, not just investor speculation. Let us look at the actual numbers. Yes, industrial use now accounts for over half of total silver demand, much higher than historical averages. The Silver Institute data is clear. We have seen annual deficits every year since 2021. Together, these deficits have removed hundreds of millions of ounces from above-ground stocks. In 2025 alone, another large shortfall is expected, even if some sectors slow down a little. Solar demand has grown enormously. Despite improvements that use fewer grams per panel, total global solar capacity keeps expanding rapidly because of government policies in China, Europe, the United States, and many other countries. Electric vehicles make the situation worse. Each vehicle uses 25 to 50 grams of silver, far more than older cars. Sales in 2025 have exceeded most forecasts. The artificial intelligence boom added another unexpected layer. Data centers need silver's unmatched conductivity for servers and connections. Global computing power has multiplied many times, and that directly translates into higher silver consumption. All these sectors together create demand that cannot easily be reduced, no matter how high the price goes. The repeating patterns are obvious in the market data. Delivery volumes on COMEX increased sharply as more contracts were taken for actual physical metal. This forced short sellers to find real silver in a tight market. The futures price curve showed backwardation, near-term prices higher than future prices, a clear sign of immediate shortage. Lease rates reached levels not seen in decades. This rewarded people who held physical silver instead of paper claims. Investment money started flowing in the same way as past rallies. When prices break long-term highs, new buyers join, making the squeeze even stronger. But unlike older monetary-driven rallies, the main force in 2025 is real consumption. Metal is leaving vaults and going into factories, where it stays for many years before any recycling is possible. These similarities are not accidents. They are direct results of silver's unique position in the world. When industrial demand reaches over 700 million ounces per year, one of the highest levels ever recorded, and total supply, including recycling, stays around 800 to 1,000 million ounces, any extra growth tips the balance dramatically. Over the past 5 years, the world has removed approximately 820 million ounces from existing stocks. This has seriously reduced the buffer that used to keep prices stable. This is not wild speculation. These are fundamental supply and demand forces finally catching up after years of underinvestment in mining and too much reliance on paper markets. So, what does all this mean for the future? Here are 3 clear takeaways from everything that has happened in 2025. First, structural deficits in commodities like silver do not disappear quickly. Because most silver is a byproduct of other mining, new supply cannot increase fast when demand rises, even with higher prices encouraging new projects. It often takes more than 10 years to open a new mine. This means tightness can last for many years and supports higher average prices over long periods. Second, the growing dominance of industrial demand completely changes how silver behaves. Unlike gold, which is mainly a monetary metal, silver's price is now closely tied to global trends in electrification and digital technology. Solar power, electric vehicles, and artificial intelligence are not short-term trends. They are multi-decade transformations, supported by government policies and technological progress. As these industries grow, silver's minimum yearly consumption will keep rising. This creates a much higher price floor even during economic slowdowns. Third, short squeezes make underlying trends much more extreme, but they also expose weaknesses in the system. Paper futures markets allow huge positions that sometimes have little connection to physical reality. But when physical shortages appear, through high deliveries or falling inventories, the price adjustment becomes very sharp and sudden. This rewards people who own actual physical silver and punishes those who took excessive risk with leveraged bets. One important question remains open. If these deficits continue into 2026 and beyond, as most analysts currently expect, where will the extra metal come from? Above-ground stocks are limited. We cannot keep removing large amounts every year forever without creating even greater volatility. Could we eventually see prices that make today's $67.40 look low? Or will new innovations and alternative materials finally limit how high prices can go? The story of silver in 2025 shows us how quiet, gradual buildups can lead to sudden and dramatic changes. Understanding these cause and effect relationships, from historical examples to today's powerful demand drivers, helps us prepare for whatever comes next. If this video has increased your interest in precious metals or how markets really work, please hit the like button. Subscribe for more detailed analyses like this one, and leave a comment below. Do you believe this squeeze still has more room to run higher, or do you expect a major correction soon? I read all comments and love hearing your thoughts. Thank you for watching. Stay informed, and I will see you in the next video.